All right, so I'm glad that you looked at part one. This is part two. We talked about wealth, we talked about the mindset, we talked about ownership versus being an employee. We talked about shares, we talked about share price. All right, now we're going to go into some other terms that you may hear, but it should not throw you off. You've probably heard of market share. All right, really, when you just break down the semantics, it's just the share of the market. All right. And when we think about that, there's a certain percentage. All right. And based on that percentage, that really goes into the riskiness of the certain investment. However, when they talk about the market size, when they talk about the market size, they're really talking about a specific industry. Now, how I like to look at it is if we're going to play investing, right, then we want to get the Michael Jordans of the industry. We want to get the best stocks of the industry. One of the methods or one of the types of ways that I like to play is for long term, and what that means is 1 year minimum. 1 year and a day. That helps with tax purposes. Also, understand when you're investing in stocks, this is a long-term game. This is not something, at least from my, and if you want further advice, I suggest going to your local professionals at like Merrill Schwab, some of these other places where they have professionals talking to you about it. However, I think that there's just some type of knowledge just to get in the game, and so that we're not scared and we're missing out on this money play. All right. So we want to think long term. We want to think 5 to 10 years. All right. I would say 20 years or what have you, but I know that we want to enjoy the fruits of your labor. But I will say that when you hold for a long time, you don't have to worry about when the economy does a downturn, because the economy will have a downturn, or a respective company goes through slow seasons. All right. Now, I talked about in the previous video where certain companies may sell a lot of stock. And I talked about also in the first video about supply and demand. So if a large company sells a lot of stocks, then basically the supply goes up. If the supply goes up, then markets, spectators, analysis, or analysts, they believe that the value of the stock goes down. And 9 out of 10, if a firm or multiple investors, and when I say investors, that's firms, other businesses, and what do they call us? Consumer buyers. Basically the small guys. That's all thrown in together. So if a lot of people sell at one time, there may be something wrong. However, sometimes they call them big whales or big sharks. They know that they'll sell, and a lot of people will sell off at a large time, so that they can manipulate the price. Because basically, if the company can get the price lower, then basically the bigger companies can come back in at a later time and then buy that respective company on a discount. And basically, that's how you're going to get the bang of your buck. And that's why you have all these different shows. They're talking about what this stock is doing, basically so that we know how are we going to buy a specific stock at a specific discount. All right? Basically getting the most value, so that you basically are mimicking what I just provided as an example with the big companies. You buy it at a discount. So, and I'm gonna break that down in a relative example. So, in the previous video, I talked about buying the stock at $1 and then it going to $2 and you selling it and you make a $1 profit. Now, buying it at a discount is if you find out that this same company is valuable. However, they're selling this stock that you know should be valued at $2, okay? Should be valued at $2 and it's going for 50 cents. Okay? If you can get it there, then you know based on trends, okay? Based on how the economy goes, that it's going to get to $2. And a lot of times when it gets to this price, or if it's been to that price, there's a good chance that it's going to get to a higher price. And if you buy and hold for over a year and it gets to your specific price, then you make a profit. And as I mentioned, this is an example of one share. But let's say you buy 10 shares. Let's say you buy 100 shares. Then obviously you have a good profit. Now, it's important to also know, all right, that when it comes, it's important to know, because we're going to go over another term that you probably heard, and this is really where the money machine comes in, and that is dividends. Dividends. So every company or corporation, we talked about that in the previous video, only corporations are the ones that issue shares of stock. So if when they have shares of stock, some people invest in a company based on the value of that company, and if that price is going to go up, just as I described previously. Other times, investors, they go based on dividends. What dividends are payments from the company that you invest in, and those payments can come out, they can come out monthly, some of them. They can come out quarterly, so every 3 months. And semi-annually. So sometimes people, what they do, they'll buy a company and they know I'm going to make a certain amount. Basically, dividends are the profit that the company makes and how they're going to distribute those profits. Now, they have an option. They can take that profit and it can go into higher wages for their employees. Or they could take those higher profits and then create higher dividends. So that's why we have a board, because they care about their shareholders, that might say, you know what, we want to increase the dividend. When you increase the dividend, then basically you attract more investors, because people, as I mentioned, they care about the dividend amount. So based on that, it's based on a percentage. So when they issue it out, let's say for that same company that costs $1, let's say it's rare you see, I mean, it's not going to say rare, but a lot of times you get your dividend quarterly based on those earnings report. Let's say out of that $1, the quarterly dividend is 25 cents. Okay? To make what I said make more sense would be if we increase the dividends to where an investor can make, let's say, 45 cents. Okay? If and once again, this is one share that's doing this. One share went from 25 cents to 45 cents. But once again, if you have hundreds of shares, then you run into some profit. Now, what a lot of people do when they get this dividend, they reinvest it into the stock, or that's a payday. That's a payday. And the whole thing is, when we think about wealth, and I talked about this in the first video, when we talk about wealth, all people do is take this excess free money. This is free money. Okay? You got $1, say it's a hard-earned dollar, or you got it from cash flow, or what have you. But basically, that dollar you invested, it created 45 cents. Okay? Of free money. What people do, and this is dealing with compound interest, is they'll just keep investing. They'll keep that in, and then basically say that $1 and now 45 cents, the next quarter can make an additional 45 cents. And that's how, so that's where you understand where people hold a stock for about, where people hold a stock for about 10 years. Okay? So dividends, that's what's attractive. So basically, if I put everything together, it's about the value of the company. Okay, people buy in to the value at a discount, and what's also attractive to investors are dividends, payouts. Okay, a lot of times people take the dividends and that's just free cash flow into their business. Okay, and then